The Why Now hook. Visual rapid montage of 2026 trading charts, failed and funded stamps appearing over trader faces. The prop firm industry just hit a massive turning point. In 2026, we've moved past the era of cheap, unregulated firms that disappear with your profits. Today, it's about institutional reliability. If you're a furniture worker by day or a full-time trader, the goal is the same: accessing real capital without the fake rules. But with so many options, how do you choose? Today, we're breaking down the industry leaders like Maven Trading and Think Capital to see who is actually paying out and who is just selling dreams. If you want to get funded this month, you need to understand the new rules of the game. Let's dive in. Maven Trading, the no-pressure leader. Visual, Maven Trading logo. Screenshots of their two-step challenge dashboard. Let's start with a fan favorite, Maven Trading. In 2026, Maven has stayed relevant by doubling down on unlimited time. Their two-step challenge is the gold standard for traders who don't want to rush. You have an 8% target for Phase 1 and 5% for Phase 2. But here is the 2026 update you need to know. Maven now calculates its 8% max drawdown as static from your initial balance. This is huge. It means your loss limit doesn't crawl up behind your winning trades. However, watch the 4% daily limit. It's calculated based on the higher of your balance or equity at the 00 UTC reset. If you're holding trades overnight, you need to manage that floating equity carefully, or you'll wake up to a breached account. Think Capital, the broker-backed powerhouse. Visual, Think Capital logo, TradingView integration clips, professional office setting. Down. Next up is Think Capital. If security is your main concern, this is the 2026 heavyweight. Because they are broker-backed by Think Markets, they offer something most firms can't: institutional-grade execution. No more weird slippage during news events. Their dual-step challenge is very similar to Maven's, but they offer a higher profit split, up to 90% if you use their scaling add-ons. They also introduced the minimum profitable days rule. You need at least 3 days where you make 0.5% profit before you can move to the next phase. It sounds like a hurdle, but it's actually a safeguard to prove you aren't just getting lucky on one high-lot gamble. It's about building a career, not a lottery ticket. Understanding 2026. Drawdown, the silent killer. Visual, red and green line graphs showing trailing versus balance-based drawdown. This is the most important part of the video. If you don't understand this, you will lose your fee. In 2026, firms use 3 types of drawdown. 1. Static drawdown, the best kind. Your limit stays fixed at a set number. 2. End of day, EOD, drawdown, only updates at the daily reset. Great for intraday volatility. 3. Trailing drawdown, the danger zone. As your account grows, your floor moves up. If you hit a $5,000 profit and then a $3,000 pullback, a trailing firm might blow your account even though you're still in profit. Always, and I mean always, check if your firm uses intraday trailing before you buy. Firms like Maven and Think Capital have moved toward more trader-friendly balance-based models, which is why they are leading the 2026 rankings. Strategy: passing the 50K challenge. Visual, 0.5% risk calculation table, person calmly placing a trade. So how do you actually pass? In 2026, the 1% rule is dead. The pros are now using the 0.5% strategy. On a 50K account, 0.5% is only $250. It sounds small, but it gives you a massive psychological cushion. You can lose 4 trades in a row and only be down 2%. This keeps your head clear so you can wait for your A+ setup. Also, avoid the news red folders. Most 2026 firms, including Maven, have a 2-minute no-trade window before and after major economic releases. If your trade hits TP or SL during that window, it's a violation. Don't let a 30-second news spike ruin a 30-day effort.